Hey everybody, Jimmy here. Welcome back to the channel. Hope you had a great holiday weekend. It's been a few days since I've posted, so I'm really excited to be back. In today's episode, I'm going to break down some ETFs from today. I want to talk about sort of what natural gas did, what crude oil did. We're also going to dive into gold, and then we're also going to discuss the NASDAQ, the E-mini /NQ. So we'll get to that breakdown. And then I want to talk about how I made $2,500 this morning. It's very different than what I've been doing in the past, but I've slowly been getting into sort of a different style of trading. It does involve some options information and style. I want to introduce that to you guys. I've mentioned it in previous videos and asked if anyone had any interest in options. And there's one thing in particular that I want to talk about in this video, and I also want to talk about the upsides and downsides for the strategy that I deployed this morning to make the $2,500. It's by far my biggest day ever in the markets, but it seemed like a very simple strategy, so it sits a little uneasy because you expect it to be really difficult. So I want to break all that down for you, talk about it, and then I want to hear your questions. Put them in the comments below. Let me know, and if you have experience in what I'm doing and what I'm going to introduce to you, please comment and let me know. Reach out. I'd love to talk and communicate, and maybe you can educate me on a few of these things, and I can kind of share more details about my strategy. So let's go ahead and jump in. So today is going to be kind of a different style video for me and for the channel, just because I'm going to be talking about how I made $2,500 this morning trading options. Now, I know for me, options were something I didn't fully understand a while back, and it made it kind of awkward because I was so focused on trading stocks and day trading. I didn't want to really learn anything else at that time, and I came upon a concept called covered calls, and it sort of changed my trading style, and I just want to share that with you guys. And then I want to talk to you about what I did to make the $2,500 this morning. My biggest trading day ever, so I'm really excited, but again, it's like I'm hesitant because it was just so crazy. So I want to dive into it. So a covered call, just to introduce it real quick, I'm going to bring up a whiteboard here. So with a covered call, let's say that you buy a stock at this level, and we're just going to call this level, let's call it $30. So you buy the stock at 30, and what you can do is you can then sell the rights to someone else. You can give someone else the opportunity, but not the obligation, to buy that stock from you at a certain price called a strike price. So let's say you bought this stock at $30, and then let's say the strike price is $35. Okay? And that's up here at this level. And sorry, those lines aren't totally straight. So you bought at 30, and you wrote a covered call, which is an options contract, meaning you own the shares, and you're going to sell the rights to someone else so that if this stock goes above $35, they have the opportunity to buy the stock from you at $35. Okay? So stick with me. Here's the stock price. So we're going to say the stock starts to move up and you own it at 30. Say you bought, let's just call it 100 shares. You bought 100 shares at $30. And the stock and the strike price is 35. So when you wrote the covered call on this at 30, you said, someone else, if you pay me a premium right now, you can have the opportunity to buy this stock from me at 35, regardless of what the price is. So here's the example. The stock price is just meandering, and this contract you wrote with someone else, it's going to go 30 days. So in 30 days,
they have the opportunity to buy this stock from you at 35. If it goes beyond 30 days, then the contract expires and they no longer can buy it from you at 35. So the stock's moving around, and then let's say 3 days before expiration, before the expiration date on this contract, the price does this. And let's say it went to 40. Now, it's the last day of the month, and the person who paid you a premium in order to have the right to buy this stock at 35, they're sitting there saying, the stock's at $40. So if I exercise my right that I paid the premium for, I can buy this stock from this person at 35. So they go ahead and do it. They buy the 100 shares at $35. Well, what happens is that stock that they bought at 35 is already at 40. So they're already up $5 right here. So they're already up $5 on this. So their current value on that 100 shares, they've just gained $500 simply by paying a premium in the beginning of the month and then waiting to see what happens. So at the end of the month, the stock was at 40. So they decided to go ahead and buy those 100 shares from you at 35. Now what they do with it now is up to them. They could sell it immediately and make the $500 profit, or they could just simply continue to hold the stock and see if it goes higher in the future. That's totally up to them. So that was the first scenario. Now, let's say instead of breaking above and going to 40, let's go ahead and let's erase this. And let's say that instead of breaking above 35 and going to 40, let's say the stock does this. And now we're at the end of the month, and let's say it's at $33. It hasn't gone above 35. So the person who paid you the premium to have the opportunity to buy it from you at 35, no matter what the price is, they can't because it's not above 35. It's at 33. So at the end of the month, the contract, the covered call contract, just expires. Nothing happens. So I keep my shares. I keep the 100 shares. In the first scenario, when it went up to 40, those 100 shares were taken from me. They call it being called away because the person that bought the rights to my shares decided to exercise it and take them from me because it did go above 35. Now, I've been mentioning this premium that they pay. So the party that pays me a premium to have the opportunity to buy this from me if it's above 35, that premium is on what they call an options chain. It's just a list of prices, and I'll show it to you here in a minute. But what happens is, let's say the premium was $1 per share. So that means that when I sold the rights to this 100 shares to another party, I got paid $1 per share. So that would mean that this premium contract for me, I made $100 no matter what. So if this stock goes up and they decide to buy it from me at 35 because it was at 40, I still keep my original $100 premium and they have to buy it from me at 35. Well, I bought it at 30. So I still get that $5 gain. So even though the shares are being taken from me, I still keep the premium and I still get paid at the higher price, at 35, at the strike price, which is higher than what I paid for them. Now, if the stock did this and was at 33, I still keep the $100 premium, I keep my shares, and I can choose to then sell my 100 shares at 33 or just hold them and see if they'll go higher. That's totally up to me. So what happened in my scenario with a stock I just traded was I got a $10.41 premium. And I got that on 200 shares. So what this meant for me was that I sold the rights to my 200 shares to another party, and they paid me a $10.41 premium. So that's $2,082 that they paid me just to have the right to buy the shares at a certain price. And that price is on ticker W, which is Wayfair. And the price, which is called the strike price, it has to go above $155 per share in order for them to have the opportunity to buy them from me. If it does not go above $155, the contract expires, I keep my shares, and I keep the premium. And I can do with the shares whatever I want. So this was my situation this morning, scenario one. Then, in addition to this, I also got a $1.95 premium on another 200 shares, and that was on ticker symbol TWTR, which is Twitter. Now, the reason I chose these two stocks, I'm going to show it to you in a minute, but I like the daily charts on them. I felt like they were strong stocks showing signs of growth, and I was interested in collecting a premium and seeing what happens, because if my strike price isn't reached and the contract expires, I'm okay keeping these shares. These are two stocks that I'm okay holding on to, Wayfair and Twitter. So when I got this premium this morning, this paid me $390, which if you add these two together, it comes in just under $2,500 total. So this was my morning. So the expiration date on these is going to be in late August, around the 23rd, and at that time I'll know if I'm keeping my shares or if my shares are going to get called away on both of these scenarios. So this is kind of the breakdown of what a covered call is, meaning you own the shares and you're just selling the rights to someone else for a premium, for the $1 per share, or for the $10.41 per share, or the $1.95 per share. And you get that premium and you keep that premium no matter what happens in the scenario. Whether they get to buy your shares from you or you get to keep your shares, you still get the premium. So, flipping over here to the charts now, if I type in Wayfair. So on this daily chart, I simply liked how Wayfair had set these 2 points, overhead resistance, then broke it violently, and then bounced a bunch of times through here. It's sort of setting up a nice support level. So when it bounced again and started to come back up, it had this nice bullish engulfing daily candle, and that made me think, okay, this might be a good opportunity to write a covered call, take the premium, give it a month, and see where we are. That's exactly what happened. Now the strike price, you can see, is right over here at the 155 level. So this is generally where the strike price is. So I bought in at 150, and the strike price is 155. So I have 200 shares. This is $5 difference. So if the stock goes above 155 and someone decides to exercise their right to buy the shares from me at 155, then that means I'll make another $1,000 because it's a $5 difference. I bought at 150, the strike is 155, and I have 200 shares. So I have my premium of $2,082 plus this possibility of another 1,000, so it would give me a little over $3,000 on this transaction for the month. So it can be very, very interesting, very lucrative if you can find stocks that you believe are going to move higher or even just a little sideways, so that you can maybe keep the shares and keep repeating this process month after month. Now for Wayfair, I'm going to click on this tab. This is the options chain, and I'm going to move myself over here for a minute. This is the options chain, and if you click on August 23rd for expiration date, you can see down here, and I know this is a lot of numbers and kind of confusing, but right here you can see this tag. This is my position. This is where I'm in. $155 strike price, and you can see these are the premiums. 1060 is where it is right now. So the options chain is where you can come in and look and say, I'm interested in holding something. Like you could even hold, there's a 554-day options chain. So you could come in here and use this, and you could say, I don't think this stock's going to go above 200 in the next 500 and so many days. So I'm going to take 2360 premium, buy a certain number of shares, and then see if it breaks above that level. You can do all this stuff, and we can get into this in another time. I don't want to get too far down this rabbit hole because it can be kind of confusing, and there's a lot of information that goes into this. But this is known as the options chain, and this is my option. This is where I am right now, and these are the premiums, the bid and the ask on the covered call premiums. So to go back to the charts, that was my Wayfair experience. And now I want to just flip over real quick to Twitter, and I want to show you where I got in on this. So you can see I sort of drew this support line, and I liked that Twitter consolidated in here and then broke above that level and then sort of started bouncing on it and using it as support. So I went ahead and did the same thing. I came over to the options chain. You can see my position right here on Twitter. And now it's at $2.02 for the premium per share. I bought 200 shares, sold the rights to someone else for this $2 premium, and now we're waiting until August 23rd to see whether or not this stock goes above a strike price of $38.50. So we can look at the chart and we can say, okay, $38.50 is right in here. So if the stock stays below this price, I will keep the shares and the premium. If the stock breaks above that price, I keep the premium and my shares would get called away from me. Someone will go ahead and buy them from me if they want to, and I'll get paid $38.50 for my 200 shares. Now, I got the shares at a cheaper price. I got the shares down here in the 37s. So I'll make profit on that level, on that as well. So the downside is you can lose your shares, but you still get paid higher, so you still make money. Now the stock could go down, and one thing people try to do is every time that you write a covered call and get paid, say, a $2 premium, if you bought the stock at $37 and you get a $2 per share premium, it's sort of the equivalent of the stock being $35 for your purchase price. So every time you write a covered call, you're kind of bringing your cost per share down by the premium amount. So after enough time, if you did this for months and months and months and months, you could bring your cost way down, like, into the 20s or whatever, while the stock's maybe trading up around 40. So Keeping your shares and continuing to write covered calls is advantageous because you're lowering the cost of your overall shares, if that makes sense. We can get into this further. I'm trying to gently just introduce this to you guys and what I've been doing, but that's basically the gist of what happened. I just went ahead and on 2 different stocks, I wrote, they call it a buy right. I wrote covered calls on Wayfair and a covered call on Twitter. And these are the amounts that I got paid in the premiums. And I keep that premium no matter what happens. And we'll know what happens when it hits the strike price of 155. And then on Twitter, that strike price was, grab my chalk here, we had the strike price of 38.50. And if it goes above that price, then the person that paid me the premium, they have the opportunity to buy those shares from me. They don't have to, but they do have the opportunity if they want to take advantage of it. So that is what I did this morning to make $2,500. Please ask questions and let me know. I promised you guys I was going to break down some ETFs, so I want to go ahead and get into that and just look at a few things from this morning. So let's go ahead and just look at natural gas, and we'll kind of get back to something a little more standard for the channel, a little more normal. I'm going to actually put in a different study set, and let's go ahead and take a peek. So this morning on natural gas, let me move myself back over here. So this morning on natural gas, you can see that right around midnight, 1 a.m., we started sort of trading between the middle and top VWAP. So kind of bouncing around in here, and then a nice big push early this morning where we went up nice and high. I'm going to zoom in on this section. So we got a high here, and then it pulled back. We got another high and another high. So I'm just going to kind of draw a line through here, maybe right on this one. I'll just draw a little line through here, like that. So then it sold off, and we dropped down. It's 5:56 in the morning my time, popping back up. We keep moving forward, and then we get to opening bell. So now we're trading here, just sort of chopping around, and I think the reason for this was because we had the natural gas report that came out this morning. So watching this, you can see 1 hour after the market opened, it ripped up nice and high. And this was obviously due to that natural gas report. So if I drag this up, you can see my RSI on this is at that point right in here was very oversold. So that's something to really watch, because once you get super oversold, then you want to see maybe a breakdown, and you could ride this back down to the middle VWAP or even down to the lower VWAP band. So what happened was we got this sort of big bearish engulfing candle that came in, a little pause, and then it continued to break down. So you could have probably looked for this in this area to move down. And if we look at, let's say, 8:41 a.m., then you would want to be looking at DGAS, which is the inverse ETF. And if we look at 8:41 this morning, right here, so it broke above this 15 exponential moving average, which is a good sign, and then it closed above it. So you could have jumped in long right in here around 126.90s, right in that area. And you could have just held it, and if you'd have held it to basically back up to where these candles were, that would have been about 1.92%. Now, if you'd have held until right now, you'd be looking at more like 2.6%. So good profit margin, that seemed to be worth it. And if you pushed up, you would have seen that it then pulled back into the middle VWAP, and then sort of chopped around and moved higher. So it sort of set up a little support level there on DGAS. So that could have been a nice move that you could have taken advantage of this morning on natural gas. So let's look at gold. Let's see what gold did this morning. Let's take a look at gold. So gold opened up this morning. So you can see right around 3:50 in the morning, we started downtrending. We pulled back into the middle VWAP and sold off hard. Tried to recover, but every time was just kind of getting rejected. Got a little closer to the 180-day moving average and got rejected. And now we're sort of back in that area again. So right now on gold, I would probably wait and see if you get a reaction here. If we pull up into the 180-day and then start to show lower highs and lower lows, it might be worth then taking a peek at the inverse ETF for gold, which a lot of times I like to use JDST and look to take this possibly long back to these highs, which could be about 2%. So that might be a nice opportunity on gold from this morning. And that's kind of happening real time right now. And then let's also just take a look at CL's another one that's been moving around a lot. Let's take a peek at this one. So this one was trading, looks like between the middle and top VWAP for part of the early morning, and then it dipped below, pulled back up, sold off a little bit, pulled back up again, started to sell off, and then it just ripped back up and gave a pullback. So this would have probably been a nice entry opportunity just because it was demonstrating a support level. And if you would have gotten long maybe around 9:30, you could have looked at UWT, which is the corresponding ETF. And let's see at 9:30 on this thing. Yeah, right at 9:30 it broke above. You could have got long above the 15-day exponential moving average. So if we look at this margin for profit right here, so not as good, about 0.6. It didn't give a real significant pullback until there. So this was may have been a little tricky to take. You know, and obviously it's still trending higher. So if you'd have gotten long here, you know, you're at 0.67% profit, but you could, you know, who's to say it could keep moving up for the day. It's not breaking pattern. It's still setting higher highs. So I would just watch for higher highs and higher lows and see if it can keep moving north. And it might end up being a really nice trade for this morning. So that's /CL. So that's natural gas this morning. That's gold, and that's light sweet crude oil futures from this morning. Leave me comments below. Let me know how you guys did today. Let me know if the future or if the options talk made any sense at all. I want to hear your thoughts on that. I want to know if you want to hear more information like that on this channel. It's something I'm starting to gravitate towards, and it's paying off really well. It's a way to really set up an income level for you that could be something you do every week that generates a pretty decent living. If you know, it can be capital intensive, but you can look for stocks that are not as high priced. You know, like Twitter is not a $100 stock. Twitter trades, you know, if we look it up right now, Twitter's trading for $37.58. So, you know, you could buy, you know, 100 shares of that, and that would be relatively inexpensive to take advantage of the options chain and getting a premium. So let me know what you think of this. I hope you guys had a green day. It's good to be back on the channel, ready to get rolling again and get after it. So thanks for stopping in. And if you haven't, hit the like button for me. And if you're new to this channel, please consider subscribing. I'll give you access to continued content. I try to post daily. I do a lot of trade recaps. I do a lot of ETF breakdowns on natural gas, crude oil, gold, and then typically the NASDAQ E-mini. So if you're into that, hit that subscribe button, stick around, and we get more videos. Have a great day, and we'll see you tomorrow. Thanks, guys.